Welcome to the session on the fundamentals of corporate finance. Today, we will uncover what corporate finance is, why it's essential, and how it impacts businesses. Now, let's discuss the modules in this particular session. So, we will be having 6 different modules. The first module will be a brief introduction to corporate finance. Second module will be about core concepts and valuation. Third module will be mergers and acquisitions. Fourth module will be capital financing. Fifth module will be dividends and capitals. And last module will be about a use case. So I hope I made myself clear with the agenda. Now let's get started. Introduction to Corporate Finance Fundamentals. This course is designed to help you understand how businesses plan and manage their money, from raising capital to fund growth to investing in new projects and returning value to the stakeholders. We will cover key concepts like capital markets, financial valuation, and funding structures, concepts that are essential whether you're analyzing a startup or a Fortune 500 company. Now, let's proceed further and understand the key topic of today's session, which is about what is corporate finance. Corporate finance is all about managing a company's financial activities and decisions. These range from choosing between fund options like equity or debt to evaluating whether an investment adds value or not. It is not just about raising money. It's about doing so wisely that it grows the company profitability while managing all the risks. Now, let's move ahead into the key objectives of corporate finance. At its core, corporate finance aims to maximize stakeholder value. That means making decisions that lead to long-term profitability. It also involves optimizing the capital structure. That's a mix of debt and equity, ensuring the company has enough liquidity to operate and that it's protected against any financial risks. Now we will proceed further and understand primary versus secondary markets. The capital market is divided into primary and secondary markets. In the primary market, companies issue new securities directly to the investors. Think IPOs. In contrast, the secondary market is where existing securities are traded amongst investors, like buying or selling stocks on the exchange. While the primary market helps raise new funds, the secondary market provides liquidity and pricing benchmarks. Proceeding further, we will learn about types of financial participants and transactions. The world of corporate finance involves a range of participants: companies seeking funds, investors providing capital, financial intermediates like banks, and regulators ensuring fairness. The transactions span equity, debt, mergers and acquisitions, and complex instruments like derivatives. Each plays a unique role in enabling efficient capital allocation across the economy. Now, we will be proceeding with the second module, core concepts and valuation. Here, we will begin with capital investment overview. Capital investment overview of a company decides to spend on long-term assets like new factories, technology, or acquisitions. These decisions are crucial because they determine the future earnings and competitiveness of the business. But investing capital is not enough. It must generate returns that exceed its costs. Now, we will move ahead in discussing the time value of money. The core principle in finance is that a dollar today is more valuable than a dollar tomorrow. This is due to the opportunity cost and inflation. That's why we discount future cash flows to evaluate projects and investments today. It forms the basis of methods like NPV and IRR. NPV stands for net present value and IRR stands for internal rate of returns. Now proceeding further, we will discuss the net present value or NPV for short. NPV calculates the present value of all expected future cash flows from an investment minus the initial cost. A positive NPV indicates value creation, while a negative NPV suggests a loss. Moving ahead, we have internal rate of return. or IRR for short. IRR is the discount rate at which the NPV of a project becomes zero. It represents the project's expected return. If IRR exceeds the cost of capital, the project is financially viable. However, IRR can be misleading for projects with non-conventional cash flows or multiple IRRs. Now, followed by this, we will understand the terminal value. Most valuation models only forecast a few years ahead. Terminal value estimates the worth of a business beyond that horizon. It is usually calculated using the perpetuity growth method or an exit multiple. Since it's often a large component of total valuation, it must be carefully estimated. Up next, we will learn enterprise value versus equity value. Enterprise value reflects the total value of a business, debt plus equity minus the cash. It is what an acquirer would pay. Equity value is what remains for stakeholders. Analysts prefer EV for comparing firms with different capital structures using ratios like EV by EBITDA. With that, let's move ahead to learn unlocking the drivers of value. The value of any business comes from its ability to grow revenues, expanding margins, improve return on invested capital, and reduced risk. Strategic investments, cost controls, and financial discipline drive these outcomes. Now, in the next slide, we will learn about valuation metrics. Valuation metrics help compare companies. EV divided by EBITDA is popular because it is capital structure agnostic. The P divided by E ratio is commonly used, but it can be skewed by accounting. More refined ratios like PEG and price to book add context depending on industry dynamics. Proceeding further, we have capital decision rules. NPV and IRR are the two most robust decision rules. Always choose projects with positive NPV or IRR greater than the cost of the capital. The payback period, while simple, ignores the time value of money but helps assess liquidity risks. Moving further, we have an introduction to financial modeling basics. Financial models are spreadsheets that project a company's revenues, cost, cash flows, and valuation. They combine business logic with financial theory to stimulate performance. From mergers and acquisitions to IPOs to internal budgeting, financial modeling is an indispensable skill. Now, let's move ahead with our next module, which is about mergers and acquisitions. Let's get started with the mergers and acquisitions overview. Mergers and acquisitions, oftenly abbreviated as M&A, are pivotal strategies companies use to grow, enter new markets, or gain competitive advantages. In simple terms, a merger occurs when two companies come together to form a new entity, while an acquisition is when one company takes over the other. M&A activities are often seen in highly competitive or consolidating industries like technology, pharmaceuticals, and banking, where inorganic growth can be faster and more efficient than building capabilities from the scratch. But M&A isn't just about financial metrics. It involves legal strategies, cultural and operational alignment. A deal may look great on the paper, but fail in practice due to integration issues, cultural clashes, or overpaying. Understanding how M&A works, who the players are, and what the risks and opportunities involve is the essential part of any corporate finance professional. Now, let's move to the next part, which is about types of buyers. M&A buyers generally fall into two broad categories: strategic buyers and financial buyers. Strategic buyers are typically other companies in the same or related industries. Their goal is to enhance synergies by expanding product lines, entering new markets, or achieving cost efficiencies. For example, when Disney acquired Marvel, It was a strategic acquisition to enhance its entertainment portfolio. Financial buyers, like private equity firms, are primarily interested in investment return. They aim to acquire a company, optimize operations, improve profitability, and then sell it after a few years. Strategic buyers tend to pay more due to synergy potential, while financial buyers are more disciplined in valuation, focusing on internal rate of return, or also known as IRR in short. The seller's decision is often dependent on the long-term vision, whether they want a partner for growth or simply an exit with minimal involvement. Now, we will proceed further and understand the 10-step acquisition process. Acquiring a company is a structural process that balances speed with rigor. Here's a common 10-step roadmap. First, define strategy. What is the acquisition goal? Market share, tech capability. This is the first thing that you need to focus on. Second one is target screening. You need to identify potential companies that meet your criteria. Third one is initial outreach. Begin with informal conversations to assess their interest. Fourth one, confidentiality agreement. Both parties need to sign NDAs to proceed safely. Fifth one, preliminary due diligence. You need to maintain a high-level review of financials, market position. Sixth one is valuation and offer. You need to estimate deal value using models like DCF, comparables, or percent deals. Seventh one is letter of intent, non-binding document outlining preliminary terms. Eighth one is due diligence phase, deep dive analysis into legal, financial, tax, operational, and HR risks. Ninth one is about dealing structuring and negotiation. You need to define purchase structure, payment terms, warranties, etc. And now the last step is signing and closing. Final contracts are signed and the deal is executed. Each step involves cross-functional collaboration, finance, legal, strategy, HR, even tech. Mistakes at any stage can derail the deal or reduce its value post-closure. Now we will proceed further and understand acquisition, valuation, and analysis. Valuing the target company is one of the most critical steps in M&A. The goal is to determine a fair purchase price while considering synergies, market considerations and conditions, and risk. Common valuation methods include discounted cash flow, or also known as DCF for short, based on projected cash flows and time value of money. Next, comparable company analysis, or also known as comps for short, benchmarks against similar public companies. Followed by that, we have precedent transactions. Looking at recent deals in the same industry, analysts also evaluate key financial ratios like EBI, TDA margins, revenue growth, return on equity, and debt levels. A detailed sensitivity analysis is often run to assess valuation under various scenarios. Overvaluation is a common pitfall. Companies may pay premium-based or expected synergies that never materialize. Hence, rigor in valuation is essential. Think of it as pricing not just today's value, but the future potential adjusted to execution risk. Proceeding further, we have the next part which discusses about deal structuring key considerations. Deal structure defines how a transaction is executed and has many implications for taxes, control, integration, and risk allocation. A deal can be structured as a stock purchase, whether shares of the target company are acquired, or an asset purchase where only specific assets and liabilities are transferred. Another dimension is the payment method, cash, stock, or a mix. Cash deals provide certainty but use up liquidity. That means you are going to risk the liquidity. Stocks deal align interests but dilute existing stakeholders. Earnouts and performance-based clauses are often added to bridge valuation gaps. Legal terms like representations, warranties, indemnities, and escrow provisions are built in to protect both the parties. The structure must also account for regulatory compliance, change of control clauses in contracts, and employee transitions. No two deals are exactly same. Structure is customized based on risk, negotiation power, and strategic goals. Now, let's move into the next part, which is about due diligence and synergies in M&A. Due diligence is the process of validating everything the seller claims, from financials to compliance, operations, technology, contracts, and people. Financial due diligence ensures reported earnings match cash flow. Legal diligence checks for litigation risks, IP ownership, or contract obligations. HR diligence assesses culture, retention risks, and talent pipelines. But due diligence also evaluates synergy potential. What savings or value can the buyer unlock post-acquisition? There are two types here. Cost synergies, example eliminating duplicate operations or overhead. Second, revenue synergies, example cross-selling products or expanding new markets. However, capturing synergies isn't automatic. It requires strong integration planning. Poor due diligence can lead to surprises after the deal closes, such as lawsuits, hidden debt, or employee exodus. A real-world example is the AOL Time Warner merger, where cultural clashes and overestimated synergies led to value destruction. Diligence isn't just about finding perfection, it is about understanding risks and planning accordingly. Now, let's look at one of the real-time examples. Let's consider Facebook's acquisition of Instagram in 2012. At the time, Instagram had just 13 employees and no revenue. But Facebook saw its potential in its mobile photo sharing capabilities. The $1 billion helped Facebook strengthen its mobile ecosystem and fend off competition. This is a textbook case of strategic acquisition for long-term growth. Now, let's proceed into our fourth module, which is about capital financing. Let's begin with capital financing overview. Let's begin by understanding what capital financing truly means. In corporate finance, capital financing refers to strategies a company uses to raise money to support its operations, expand, or acquire other businesses. The right financing decision isn't just about availability. It's about cost, timing, risk, and control. Should a business take on a debt and increase financial leverage, or issue equity and dilute ownership, these decisions have long-term consequences for value creation and financial health. As we go deeper, we will explore how each option works and then what is preferred and how the trade-offs are involved. Next, we will learn about business and funding cycles. Capital needs evolve with the company's life cycle. Imagine a startup, limited revenue, high burn rate. At this stage, external capital is crucial. Sources like bootstrapping, angel investment, or crowdfunding help to get better business off the ground. As the company enters the growth phase, funding needs to increase. New markets, production expansion, hiring, etc. Venture capitalists become the more accessible offering, not just capital, but also mentorship and networks. In maturity, the business has steady cash flows. Now financing shifts towards IPOs, bonds, or even reinvesting profits. Finally, during a decline or restructuring phase, funding may come from diversities or debt restructuring. Reflect for a moment. What stage is your current business or company in? What funding options are most aligned? Moving further, we will learn about capital structure, where we will discuss debt versus equity. At the heart of capital financing lies the capital structure. How much of the business is financed through debt versus equity? Debt has fixed obligations, regular interest and principal payments, but it doesn't dilute ownership. It's also tax deductible. making it a cost-effective source of capital. However, excessive debt increases financial risk, especially during downturns. Equity, on the other hand, involves giving up a share of control in exchange for its capital, but permanent does not strain cash flow. But it can be more expensive over time due to sharing profits. The optimal capital structure balances these two forces, cost and control versus risk and flexibility. Moving further, we will learn about weighted average cost of capital, or also known as WACC for short. WACC represents a blend of cost of financing, both debt and equity. It tells us the minimum return a business needs to generate to satisfy all capital providers. For example, if a firm has 60% equity with a cost of 12% and 40% debt with a cost of 6%, then the WACC or WACC might fall somewhere around 9%. This is the benchmark against which investment decisions are evaluated. Projects must return more than the WCC to add value. Useful analogy. WACC is like the hurdle in a race. Every investment must jump over it. The lower the hurdle, the easier it's to find profitable projects. But beware, adding too much cheap debts might lower WACC but rise the default risk. Now moving further, we will learn about capital stack. The capital stack is a visual way of understanding funding layers. At the base is senior debt, lowest risk, first to be repaid. Then comes subordinated debt, mezzanine financing, and at the top, equity holders, who are the last in line during liquidation. The higher you go, the more risk investors take, and the higher return they might demand. In real estate financing, the capital stacks are commonly used to align investor interests. For example, a developer might raise 60% via senior bank debt, 20% from mezzanine lenders, and 20% from equity investors. Each layer has a different term and expectation. Now proceeding further, we will learn about type and sources of equity. Equity financing isn't a one-size-fits-all solution. Depending on the company's life cycle stage, different types of equity investors come into the play. For startups, the journey often begins with angel investors, wealthy individuals who provide early capital, often based on a compelling idea or founder credibility. They take significant risk and usually offer mentorship as a part of the deal. As the business gains traction, venture capitals or VC becomes a viable option. VCs invest in exchange for equity, but they expect high growth and significant returns. Funding usually comes in stages: seed, Series A, Series B, and so on, with increasing checks and oversight. Once the company matures and achieves scale, it may pursue an initial offering, or also known as IPO for short, to raise capital from public markets. IPO bring liquidity and visibility, but also invite strict regulatory compliance and shareholder scrutiny. Each source of equity differs in risk appetite, control demands, and return expectations. Founders and CFOs must carefully consider not just the funds being raised, but the long-term implications for ownership, governance, and strategic decision. Now moving into the next part, we have private equity and venture capital. Private equity, or PE for short, firms typically buy controlling stakes, aiming to improve operations and exit with a profit. Venture capital is focused on early stage, high growth businesses. For example, Flipkart. It received VC backing it in its early years, but was later acquired by Walmart, showcasing a PE style exit. These investors don't bring capital, they influence strategy, help hire key leadership, and drive exits like acquisitions or IPOs. But they may also expect aggressive growth and may push hard for performance. Moving ahead, we will understand why to use debt and its advantages as well as risks. Debt is cheaper than equity in most cases, especially due to the tax deductibility of interest. It allows businesses to retain full ownership. It also creates financial discipline. Companies are more cautious with capital when they have to repay it. However, debt also increases risk. In a downturn, fixed obligations can cripple operations. High leverage can lead to covenant breaches and defaults. A common example: airlines' high price tickets and leveraged balance sheets often struggle in downturns despite their scale. This highlights why debt strategy must match business volatility. Now, proceeding further, we will understand assessing debt capacity. Before a business adds debt to its capital structure, it must assess debt capacity. In simple terms, how much debt can it afford without straining operations or risking default? Lenders and analysts evaluate this through multiple financial ratios. The debt service coverage ratio, or also known as DSCR for short, measures whether the firm cash flows can cover debt obligations or not. A DSCR above 1.5 is generally considered healthy, as it shows the company can meet repayments with a buffer. Another key ratio is the interest coverage ratio, which compares earnings before interest and taxes. It is also known as EBIT for short, to interest expenses. A low ratio indicates vulnerability to financial stress if earnings drop. Beyond ratios, other factors include industry stability, historical performance, revenue consistency, and even microeconomic conditions like interest rate trends. For example, cyclical industries like construction or travel are more vulnerable to downturns and may face conservative debt ceilings. Companies must not only look at whether they can service debt today but also forecast future conditions. A firm with high customer churn or uncertain regulatory exposure may choose to limit its leverage even if ratios look favorable. Managing debt capacity is about preparing for volatility, not just capitalizing or optimism. Moving further, we will learn about senior versus subordinated debt. Debt instruments aren't always equal. There's a hierarchy of claims known as the capital structure, and understanding where a debt instrument sits in the hierarchy is critical. Senior debt holds the top position. It has the first claim on a company's assets and earning in the event of bankruptcy or liquidation. Because of its lower risk, it typically carries lower interest rates. It is favored by conservative lenders like banks. Next is subordinated debt. Subordinated debt, sometimes referred as junior debt, ranks below the senior debt. If the company defaults, subordinated lenders are repaid only after senior creditors are made as a whole. To compensate for this risk, subordinated debt carries a higher interest rate. For example, in a leveraged buyout (LBO), a PE firm may use both senior and subordinated debt to finance the deal, balancing cost and risk exposure. Subordinated notes may also be issued to bridge funding gaps when equity is too expensive or dilutive. This layered structure enables financial flexibility. However, excessive layering, especially without strong cash flows, can magnify risks during downturns. Companies must weigh the need for capital against the increased vulnerability subordinate positions introduce. Proceeding further, we will understand mezzanine financing and characteristics. Mezzanine financing is a unique blend of debt and equity characteristics, hence the term hybrid financing. It sits between senior debt and equity in the capital stack, providing a bridge when traditional funding sources are insufficient. Typically, it comes with a higher rate of interest and may include equity kickers, such as warrant or options to convert into equity if the borrower defaults or reaches performance milestones. What makes mezzanine financing attractive is it allows businesses to raise capital without immediate equity dilution, while offering investors the chance for equity like returns. It is especially popular in leveraged buyouts (LBOs), management buyouts or also known as MBOs for short, and expansion funding scenarios. For example, a growing company may already be maxed out on senior loans but still need capital to enter into a new market. Mezzanine funding fills this gap with a structured repayment schedule and optional conversion into equity if the company performs well. However, mezzanine financing is not without risk. It typically has payment in kind, or also known as PIK for short, interest features, where interest accrues instead of being paid immediately, adding future repayment pressure. It's crucial for businesses to ensure strong forecasted cash flows before opting for mezzanine funding. It's a powerful instrument, but best used when upside potential outweighs the cost of capital. Proceeding further, we will learn about debt repayment schedule. How a company structures its repayment schedule significantly affects liquidity, flexibility, and credit worthiness. The three main structures are bullet, amortized, and balloon repayments. In a bullet repayment, the entire principal is paid at maturity. This gives the company maximum short-term flexibility but can create refinancing or cash flow risk near maturity. Bullet structure are often used in bonds. An amortized loan, on the other hand, spreads out principal and interest over the long term. This ensures steady cash outflows and reduces refinancing risk, but limits the company's cash availability for reinvestment. Balloon repayment is a hybrid where interest and small principal portions are paid regularly and large balloon principal payment is made at the end. Choosing the right structure depends on the business stability, expected cash flow, and capital returns. For example, a construction firm with lumpy project revenues may favor bullet or balloon repayments, while a retail company with stable monthly cash flow might opt for amortization. The repayment schedule isn't just a financial technicality. It redefines how much breathing room management has to execute a long-term strategy. Proceeding further, we have debt versus equity. Every financing decision creates trade-offs, none more fundamental than choosing between debt or equity. Debt offers speed, tax advantages, and retains full ownership, but it adds fixed obligations that can stress a company during downturns. Equity, in contrast, brings in the capital without repayment pressure. It is ideal for high growth, high risk ventures like tech startups where cash flows may be uncertain. It dilutes ownership and could shift control, especially when dealing with the VCs or institutional investors. Let's take two companies. Company A is a software firm launching a risky AI product with uncertain cash flow. They may prefer equity funding to avoid fixed repayments. Company B is a manufacturing firm with predictable earnings. They might opt for debt to benefit from leverage without giving up control. Moreover, market conditions also matter. In low interest environments, debt is cheaper and more attractive. In volatile equity markets, dilution might be too expensive. The best capital strategy often combines both, maintaining an optimal capital structure where cost, flexibility, and control are balanced over time. Now proceeding further, we will learn about credit rating and high-yield bonds. Credit rating assesses a company's ability to repay its debt, influencing both assets and capital and the cost of borrowing. Agencies like Moody, S&P, and Fitch assigns ratings such as AAA, AA, BBB, and so on. Higher ratings indicate lower risk, enabling companies to issue debt at lower interest rates. Investment grade ratings such as BBB or Baa3 and above attract conservative institutional investors. Below investment grade or high yield junk bonds signal higher risk and require higher returns to attract capital. For example, Tesla's early bonds were rated junk due to operating losses. As the firm stabilized and turned profitable, its rating improved, reducing future borrowing costs. Ratings are based on business fundamentals, financial ratios, industry risks, and qualitative factors like governance. A downgrade can trigger bond sell-offs or higher loan covenants. Companies must actively manage their financial policies and communications to maintain favorable ratings. It's not just about being solvent, it's about being as seen as reliable and resilient under pressure. Moving further, we will learn about underwriting and book building process. When companies raise funds with public offerings, they often engage investment banks to underwrite the issue. This means the bank commits to buying the securities if investor demands fall short, transferring risk from the issuer to the bank. Underwriting provides credibility, pricing, expertise, and marketing muscle. There are different types of firm commitment, best efforts, and syndicate underwriting depending on deal size and risk appetite. The book building process goes hand in hand. It's a method of price discovery where banks collect bids from investors during a roadshow. Investors specify how many shares or bonds they want and at what price. Based on this demand data, the final offer price is determined. It ensures a market-driven pricing mechanism, reducing the risk of under or overpricing. For example, IPOs like Zomato or Nike use book building to successfully gauge demand and set price bands. It balances issuer goals with market interest. Now, let's proceed further and understand the role of investment banking and roadshows. Investment banks are key planners in capital financing ecosystem. They advise firms on the structure, pricing, timing, and marketing of the capital issues. In equity and debt offerings, they act as both underwriters and intermediaries between issuers and investors. One crucial role is conducting roadshows, a series of presentations to institutional investors designed to build interest and trust. These can be in person or virtual and allow company executives to tell their story, address concerns, and clarify financials. Roadshows are particularly important in IPOs and high-yield bond issues where investor confidence drives deal success. For instance, in LIC IPO, the Indian government and lead bankers conducted extensive domestic and global roadshows to ensure maximum visibility and investor engagement. Roadshows are not just marketing, they are feedback loops. Investor questions reveal concerns that influence final pricing, structure, and even timing of the issue. Now, proceeding further, we will learn about the pricing the issue and market sentiment. Final pricing of equity or debt offerings is a strategic decision that considers both quantitative valuation models and qualitative market signals. On one hand, you have models like DCF, peer multiples, and book value. On the other, you must gauge investor appetite, sector sentiment, and competing deals. Underpricing may lead to strong listing day performance but leaves capital on the table. Overpricing can result in poor subscription, low post-issue performance, and reputational damage. For example, Facebook's IPO in 2012 was priced at a high end of the range, but technical glitches and over-optimism led to a post-listing decline. In contrast, Google's IPO used a Dutch auction to let the market determine pricing more organically. Investment bankers, CFOs, and legal advisors collaborate to find the sweet spot, maximizing proceeds while ensuring long-term investor confidence. Remember, pricing is not just math, it's psychology, timing, and trust. And with this, let's move to our next module, which is about dividends and capital return. We will now get started with this module with a brief overview on dividends and capital return. Dividends and capital returns represent how companies reward stakeholders for their investment. Once profits are earned, businesses must decide whether to reinvest these profits for future growth or return them. The two most common methods are cash dividends and share buybacks. Each approach sends a different message to the market. Now, let's learn about retained earnings versus dividend payout. Retained earnings are profits kept within the company to fuel operations, pay down debt, or fund expansion. On the other hand, dividend payouts provide immediate returns to stakeholders. Companies must carefully assess whether their cash is better used to grow the business or shared with investors. Proceeding further, we will learn about cash dividends versus share buybacks. Cash dividends offer regular income and attract income-focused investors. Share buybacks, however, are often seen as more flexible and tax efficient. They reduce the number of outstanding shares, increasing earnings per share. While dividends imply confidence in stable cash flow, buybacks often indicate a belief the stock is undervalued. Followed by that, let's learn about impact on stock prices. Dividends affect share prices in multiple ways. The announcement of a dividend may drive up the prices as investors perceive it as a strong signal for good performance. However, on the ex-dividend date, the stock usually drops by the dividend amount. Buybacks can also push prices up by reducing supply and improving financial ratios like EPS. Lastly, we will focus on the three pillars of corporate finance. To conclude, corporate finance revolves around three fundamental decisions: investing in value-creating opportunities, financing those investments optimally, and returning value to the stakeholders through dividends or buybacks. Mastering the balance among these three pillars drives long-term stakeholder value. Now, we will move ahead into the last module of today's session, which is the real-world application. Let's bring our learning to life. Imagine you're the CFO of a startup company called Green Charge, which is focused on EV battery innovation. You need 10 crores to scale operations. You have two options: raise equity by giving up 20% of the ownership to a VC firm, or take a loan with a 10% annual interest rate. Next, we have a briefing on the factors to consider. This decision is more than just about money. Equity means no interest payments, but dilutes your control. Debt lets you retain your ownership, but adds pressure on your cash flow. You'll need to consider how stable your revenues are, what growth looks like, and how much financial risk you can handle. Followed by that, we will take a look at decision simulation. Now, put yourself in the CFO shoes. Which route would you pick? Debt to stay independent, or equity to share control but reduce cash flows? There's no single right answer, but your decision must align with your capital strategy and financial forecast. Now, we will wrap up with the key takeaways. This wraps up our corporate finance fundamentals. You've explored investment decisions, capital financing, and how value is returned to stakeholders. Most importantly, you have seen how these decisions play out in real business scenarios. With these tools, you are ready to make or evaluate smart financial decisions in any corporate setting. Lastly, let's have a small quiz to put your skills to the test. This helps you understand where exactly you stand in this learning journey. So, the first question: what is the main purpose of issuing dividends or buying back shares? The following are your options, and you can leave us the answers in the comment section below. A. Increase company expenses. B. To reduce retained earnings. C. To return value to stakeholders or shareholders. D. To comply with regulations. The second question is as follows. Retained earnings are typically used for what? A. Paying taxes. B. Funding lawsuits. C. Reinvesting in business growth. D. Distributing dividends. You can leave us your answers in the comment section below. The third question is as follows. Which of the following is considered more tax efficient for shareholders? A. Stock dividends. B. Share buybacks. C. Special dividends. D. Quarterly cash dividends. You can leave us your answers in the comment section below. Now we will proceed to our fourth question. What usually happens to a company's stock price on the ex-dividend date? A. It increases. B. It stays unchanged. C. It decreases by the dividend amount. D. It doubles. You can leave us your answers in the comment section below. Fifth question. Which of the following best describes a benefit of share buybacks? A. Increases the number of outstanding shares. B. Dilutes earning per share. C. Often signals undervaluation of the stock. D. Required by SEBI or the SEC. Congratulations on completing the Corporate Finance Fundamentals course. You have successfully built a strong foundation in one of the most critical areas of business corporate finance. From understanding how companies invest capital, to mastering the strategies behind funding and returning value to shareholders, you have explored the core financial decisions that drive organizational success. You now know how to evaluate investment opportunities, structure capital efficiently, analyze risk-return trade-offs, and interpret real-world financial strategies. Whether it's funding a startup, executing an acquisition, or optimizing shareholder returns, you are equipped to approach decisions with confidence and analytical precision. As you move forward, apply these tools to make smarter, data-driven decisions, ones that balance value, certain with financial sustainability. The financial lens you have gained will not only help you assess businesses more effectively, but also contribute meaningfully to any organization's strategic growth. Thanks for being a part of this learning journey. Keep analyzing, keep questioning, and let your financial acumen lead the way. Your corporate finance story is just beginning.
Staying ahead in your career requires continuous learning and upskilling. Whether you're a student aiming to learn today's top skills or a working professional looking to advance your career, we've got you covered. Explore our impressive catalog of certification programs in cutting-edge domains, including data science, cloud computing, cybersecurity, AI, machine learning, or digital marketing. Designed in collaboration with leading universities and top corporations, and delivered by industry experts, choose any of our programs and set yourself on the path to career success. Click the link in the description to know more.
Hi there, if you like this video, subscribe to the Simplilearn YouTube channel and click here to watch similar videos. To nerd up and get certified, click here.